Good report, not a blockbuster. I think the establishment survey was clearly a little better than expected. The household survey was more mixed. Household employment growth hasn't been great over the last 3 to 6 months. But of course, the unemployment rate fell further. The U6 broad unemployment rate or underemployment rate came down. So I think overall it was pretty good.
Are we in store for more months like this?
I think so. I think this is the sort of report that I would expect for 2014 as well. Maybe somewhat stronger employment growth if we get to a stronger GDP growth rate, and we do think there will still be some acceleration. But 225 type of numbers is what I'd expect.
All right.
It is ironic. In June, Bernanke said that 7% was the rate that they expected when they ended the QE taper. So we're there now. I do not expect tapering at the December meeting.
Yes, I think many countries, including the United States, have put a real emphasis on free trade agreements, plurilateral agreements such as the Trans-Pacific Partnership. In fact, many of the trade negotiators will be continuing on to the TPP talks after the ministerial in Bali is concluded. So the Obama administration in particular has put a priority on the TPP negotiations. They would like to wrap this up by the end of the year. They see this as a potential gold standard free trade agreement for the 21st century. And really the test is if the WTO cannot reach agreement with 159 members on key negotiating issues, then smaller free trade agreements will have to fill the gap and have to find a way to address some of these pressing trade barriers that exist around the world today.
I think there are a few things to be considered. The first of all, China is the second largest economy in the world now. If you are going to have international equities in your portfolio, you should have some allocation to China. I think recent reforms that have been enacted by the Chinese government should provide a good boost to returns from Chinese equities over the next 2, 3, 4 years. Whenever you're investing in emerging markets, it's about risk versus reward. And here you've got to look at what is the risk. The index that we're using, CSI 300, are the 300 largest stocks. So you're looking at the large to mid-cap range. So it's not small caps, not doing anything that's too kind of out there. And I think also when you look at the reforms that have just been passed, certainly our economists believe that the Chinese stock market is looking at a 20 to 25% rise over the next 12 months or so. And so you've got to think to yourself, okay, what is my risk? Well, there is volatility, but that goes both ways. And if it's to the upside, that's where you're going to make money. I think over the long term, you are going to want exposure to that broader Chinese market. The growth is still strong. It's still a very, very boosted EM trade.